Over the past few weeks, a lot of people have been asking the same question. If hiring is slowing, if job growth just posted its weakest year since the pandemic, why are the interest rates still so high? Because in the past cycles, the slower jobs usually meant rate cuts. And that's not what we're seeing now. And the reason has less to do with one bad report and more to do with how this slowdown is actually unfolding. So the final job report for 2025 shows something very important. The economy added only about 50,000 jobs in December, and early months were revised lower. So when you step back, 2025 ends up being the weakest year for job growth since 2020. That sounds dramatic, but the details matters. Unemployment didn't spike, layoffs didn't surge, and most people who already have jobs are still employed. So this is not a collapse, it's a slowdown, built on caution. And this is where I think confusion really starts. When people hear weak job growth, they expect an obvious next step. In my opinion, what's throwing everyone off is that this slowdown doesn't look like the ones we used to. The signals are quieter, and that makes them easier to miss. So in previous downturns, the labor market broke loudly. Companies cut fast. Unemployment jumped. The damage was very visible. That gave the Federal Reserve a clear signal. But this time, the signal is different. Hiring slowed, but layoffs stayed limited. Open roles disappeared quietly. Positions went unfilled after people left. That labor market didn't snap. It narrowed. And I'll be honest, I think this is why so many people feel uneasy right now. In my view, it's harder to cope with a slow squeeze than a sudden shock, because there's no clear moment where you can point and say, that's what changed. So another reason rate cuts having accelerated is that the Fed has already moved, just not as aggressively as many expected. So after a series of rate cut reduction in 2025, the Federal Reserve lowered rates again in December, bringing them into the mid 3% range. But since then, officials haven't made it clear they are not convinced more cuts are necessary right now. Why? Because inflation hasn't fully returned to target. So prices are not rising as fast as they were a few years ago. That part is true. But prices also didn't fall back down. They stabilized at a higher level. Service inflation remains elevated. Housing-related costs remain sticky. Insurance, healthcare, and everyday services are still pressuring budgets. I don't think this is about the Fed ignoring the slowdown. In my opinion, they're looking at this economy and saying, we still have time, and moving too fast could make things worse. That doesn't make the situation easier for households, but it explains the decision making. So there's also a policy layer here that often gets simplified or ignored. Over the last couple of years, emergency government spending rolled off. Pandemic era supports ended. Federal hiring slowed towards the end of 2025. And at the same time, businesses adjust to higher borrowing costs, regulatory planning, and trade uncertainty. So none of this shuts the economy down, but it changes how companies make decisions. Expansions become optional instead of automatically. Hiring becomes selective instead of aggressive. And when companies pause expansions, job creation slows before layoffs ever appear. Technology also plays a role quietly. Automation and artificial intelligence didn't arrive overnight, but adoption accelerated. In many cases, companies choose efficiency upgrades instead of adding staff. So that doesn't show up as a job loss. It shows up as a few new jobs being created. From the Fed's perspective, that's not a labor market emergency. It's a structural adjustment. This is also why there's such a disconnect between financial markets and everyday experience. Market prices expectations. They look ahead to what might happen quarters from now. Households live in the present. They deal with credit card interest that's still high. Auto loans that remains expensive. Rent increases tied to financial costs. So stocks can look fine while budgets still feel tight. That disconnect doesn't mean that the data is wrong. It means The economy is adjusting unevenly. And this is where the hiring slows hits harder. When hiring slows, wage pressure slows. Job switching becomes harder. Raises become less frequent. Entry-level opportunities thin out. Even without layoffs, financial momentum fades. That's why people say that the job market feels miserable right now. Not because everything broke, but because opportunity quiet dried up. So what will actually push the Fed to cut rates faster? It wouldn't be one weak job report. It would take sustained changes, a clear rise in unemployment, a sharper drop in wage growth, or a broader consistent decline in inflation across key categories. Until that happens, the Fed stance remains cautious, not because conditions are great, but because they are not bad enough in their view to justify moving quickly. So if I had to put it simply, I think this is one of those periods where the data looks stable, but life feels harder. And in my opinion, that disconnect is what makes this cycle so frustrating for a lot of people. This cycle isn't loud, it's low. It's shaped by cautions, inflation risk, and a structural change, not panic. And that's why rates are still higher than many expected, even as hiring weakens. If you're wondering why relief feels delayed, why job searches take longer, and why nothing seems to ease all at once, this is why. The economy didn't break, it shifted. And understanding that shift matters more than any single headline. Thank you for watching.